Hi, everybody, and welcome to our live event today, which is the SME, so small medium enterprises tax year in review for 2024. So this event is brought to you live by Tax Nuggets Academy. So now introducing our wonderful instructor, Andrew Henshaw, who is the managing director at Velocity Legal. He specializes in private groups, tax disputes, and complex tax advice. And he's been keeping an eye, of course, on everything that's happened. So if you feel like nothing really happened during the year, he's about to prove you wrong in today's session. So everyone, please give a warm round of applause to welcome back Andrew. Yay!
Thanks so much,
Emoji
Vicky.
hands.
And hello, Nuggeteers. I see a lot of familiar faces on the attendee list. So that's always exciting. It's always exciting to see some of those familiar names. So well, this is a huge session. I sort of thought, well, what happened this year in tax? And sometimes I forget what happened yesterday, what I have at breakfast, things like that. So it did force me to sort of cast my mind back, and hey, 12 months went by pretty quickly, but lots happened.
Yeah, for sure. Let's get to some of those things, I guess.
Absolutely. Yeah. So it's interactive. So feel free to jump in, ask questions throughout. I'm happy to divert. There's a lot of material in the slides. So if I don't get through it, they're there, they're available, and I'm more than happy to have a Q&A session instead. But in terms of the agenda, I've sort of broken it down into those four categories being, okay, tax policy, what's happened on an ATO practice level, what products and guidance have come out, and what tax cases happened this year. And then a quick eye to 2025. Now, before I launch off, a disclaimer that I can't cover everything that happened in the year. I've sort of come at it with the view of what I do in my practice, advise small, medium enterprises, private businesses, family groups, and what I think the biggest tax things that happened during the year. So without further ado, I'll start off with tax policy developments. And I guess the overall comment is that's pretty light on in terms of what happened with tax policy. And so this is sort of a recurring theme over the last at least 5 years, I would say, that there's really not been a lot of wholesale policy development. What we've got, though, is a couple of things, and some of these I'll talk about in a little bit more detail. We had the stage 3 personal tax rate changes, some things to do with foreign resident CGT regime, the Div 296 tax, where that's at, and everyone's favourite topic, the TASA obligations, those pesky things. I've got a slide on each of those, so I'll come back to those. I've put a few honourable mentions here on tax policy developments. I've given an honourable mention really to Victoria's state taxes more than anything else. I'm based in Victoria, but I think it does win the gong for policy developments, whether those are good or bad. There are some things that are very unique now in Victoria. We have a commercial and industrial property tax, which kicked off from 1 July 2024. And we have a potentially quite nasty vacant residential land tax, which kicked off on 1 January 2024. Another honourable mention goes to payroll tax and GPs. Each state has had various pronouncements and amnesties and legislation about GPs, how much they bulk bill, are they exempt from payroll tax? So that's another honourable mention. And the final one is that the replacement of the AAT. It's now the ART. So it's one to, if you're referring to it, it's the ART. That happened about almost 2 months ago now. So in terms of what that actually means, probably not a lot, other than you have to say ART, not AAT. Or you could just say tribunal, and then you're good as well.
Yep, and they still haven't started publishing any decisions yet, right? So it's going to be a bit of an avalanche next year when that all gets
No, I jumped
everybody.
on, yeah, I jumped on Ostly and I couldn't see that they've been published yet. So there's sort of like a bit of a 2 month backlog there. So I don't know how that's going to work.
We'll see.
All right, so I'll just break down each of those. The revised stage 3 tax cuts finally came in. I've got the table there. You probably all know this back to front anyway. But we had essentially a couple of rates come down. That's the 19 to 16, the 32.5 to 30, and then an increase in the thresholds for the 37% rate and the 45% rate. Now, these are, of course, the watered down version of the stage 3 tax cuts. And you could make the argument that it's also really just kind of adjusting for inflation, but they are there now. They're in. That is something that happened this year. In respect of foreign residents and how they interact with the CGT regime, we had two changes. Firstly, we had a budget announcement to broaden the scope of what would be subject to CGT as a foreign person. And what this was essentially getting at is situations where a foreign person is disposing of shares or units in an entity that may or may not have land or mining rights or things like that. What it's doing and what it's proposed to do from 1 July is essentially broaden the test to cover a little bit more, and also include a notification requirement that requires foreign residents who dispose of shares exceeding $20 million to notify the ATO prior to the transaction being executed. Now, that second one set off a lot of sort of question marks about how that would work and what if they're not even selling land, and how would that actually work. Where this is at the moment is there's a consultation paper that's been out. The consultation's happened. I don't believe we have any updates since then, so it's a watch this space for 2025. The second one we had is a broadening of the withholding rules for foreign residents. So from 1 January 2025, the rate will increase to 15%, and the threshold will be removed. So essentially, it's a blanket. All sales of property, either there's going to need to be a withholding of 15%, or the vendors will need to supply a clearance certificate or perhaps a variation certificate. Super and the Div 296 tax, the much talked about, much criticised tax. Now, where this is at the moment is we've had the proposal. It was in, I think it was prior to a budget that it was announced. And it was that, well, okay, 1 July 2025, we're going to have this additional 15% tax where the total super balance exceeds $3 million. And in addition to just how to design something like that, it was really sort of two big issues that stuck out. Was that it was taxing unrealized gains, and secondly, that there was no indexation built into this. Where we're at now is that the bill was introduced. That date is incorrect, that it's not 30 November 2023. It hasn't got crossbench support, and we only have one sitting in Parliament left before the next federal election. So I think that this is entirely up in the air, and really depend on the outcome of the next election as to whether or not, potentially as to whether or not the entire thing goes ahead, but definitely about, particular aspects of it, like unrealized gains being taxed per member. Expanded tax agent obligations. So this has been really topical and talked about all year. Talk's probably a nice word. So we've had this very significant expansion of tax agent obligations under the TASA. This is all sort of the PwC snowball effect. A number of bills and determinations have occurred, and where we've gotten to now is we've got restrictions on disqualified entities. That was from 1 January. We have breach reporting, which started from 1 July, the so-called dob-in other practitioners / yourself. We then have upcoming dates of 1 January and 1 July 2025 for breach reporting regarding false and misleading statements made by clients. And I did see a headline the other day, just earlier this week, that the ATO's seems to be putting in place some sort of portal or website that makes it easier to dob in your client when you need to. It's important to understand those rules, and the TPB's put a lot of information out about them. The having to dob in your client is pretty limited, but there's a lot of subjective and vague words in all of this, which makes it a lawyer's field day, but it makes it very difficult for practitioners. There's, of course, other changes in the TASA, but I'm just focusing on those ones. Right. Now on to ATO practice developments. Here I'm going to talk about two, which is about discretions the Commissioner has and the medium and emerging private groups compliance activity. I've given some honourable mentions to rental properties and property generally. It seems to be that that's been squarely within the focus of the ATO. Both that published it and said that. And also I've been involved in a number of mum and dad, very small scale property developments where we actually have been queried by the ATO about, hey, BASs haven't been lodged, hey, you've been registered, or this property sold on this date, or is this on revenue account, etc. So it seems very much that's something that's happened during this year.
Yeah, and the ATO said like was it 9 out of 10 tax returns for rental properties are prepared wrong? Like that's very high.
Absolutely.
So not surprised that they've put a target on rental properties and just properties in general.
Absolutely. Absolutely right, Vicky. The other honourable mention is for workplace work-related expenses. That's something that they say every year, but and I can't say that I've been involved in particularly many of those, but I've put it on the list. The other one I've put on the list that definitely has a significant uptick is State Revenue Office, whether it's Revenue New South Wales, the Vic office, Queensland, etc. There's been a definite uptick in audit activity, and the things that I've seen are land tax. Is it a principal place of residence? Is it primary production? Payroll tax. Should this be grouped? Should it not be grouped? What about contractors? What's been paid to contractors? And there seems to be an enormous focus on audit activity and, a really large increase in audit activity from at least Revenue New South Wales and the State Revenue Office in Victoria. And I'd suspect that that's replicated through the other states as well. Now, turning back to the Commissioner's discretion. Now, the Commissioner has all sorts of discretions under the law. And the reason the Commissioner has discretions and why law is built that way is because if you make something really black and white, then it can be really unfair because if you don't fit in the category, tough, basically. So there's lots of areas of law where there's discretions available for the Commissioner. And of course, those discretions, the Commissioner has to apply proper consideration to. And for certain discretions, they can be reviewed by the ART now, and they can stand in the shoes of the Commissioner and re-exercise that discretion. So it's not a sort of carte blanche. Now, just some examples of things the Commissioner does have discretion about. The Commissioner has discretion to disregard a self-executing Division 7A outcome, like a deemed dividend. Got a discretion under Section 109RB. The Commissioner has a discretion to remit JIC and shortfall interest. And the Commissioner has a discretion to remit penalties. And in the case of the JIC and the penalties, they're very widely expressed discretions as well. There's not a lot of guidance in the legislation about what principles or criteria that need to be met. It's sort of more of a fairness test, I guess. My observation here is that all of these discretions have essentially been tightened, whether it's deliberately, whether it's from an edict at the top going down, or whether it sort of just happens to be the case. It seems everyone I've spoken to across the board has noted this, particularly about JIC remissions. if you jump on that link down the bottom right, it's from the private group's stewardship group. And it was actually noted in that group there was some comments about JIC emissions, and that it's really hard because they're not actually really reviewable. There is a technical way that they can be reviewed, but it's almost meaningless. And it's really difficult with those JIC emissions. I put up there a comment from the Commissioner of Taxation about our job is to collect tax in accordance with the law, and paying tax is an optional, and it's a responsibility to ensure a level playing field. Now, I mean, yes, it's in accordance with the law, but the law has discretions. But I think that level playing field comment, they've really come at it that, look, why should we give almost anyone a discretion almost, because then why do you get one and someone else doesn't? So I think this will continue to be an issue, and I've seen it a lot on JIC emissions, for example. Interested to hear anyone's thoughts in the comments about that as well. The other one, which I think is a big ticket item for practitioners here, is this one might have slipped under the radar, but until now we've had a top 500, which was the top 500 private groups, and then we had a next 5,000, which is essentially the 5,000 largest private groups below the first 500. And if anyone's been involved in a next 5,000 review, they're pretty wide ranging. They can go for quite a while, sort of talking 1 to 2 years for a lot of them. And they really sort of go through everything. So what the ATO has announced in October is that essentially the next 5,000, which they've called that they're going to have a focus on medium and emerging private groups. Now, interestingly, in the data the ATO says on their website is this covers 73,000 groups. So they didn't call it the next 273,000. It's not possible to review everyone in something like that, but this is sort of squarely, there could be a lot of people that fall into this. So it's talking about groups that control between 5 and 50 million of wealth, or have businesses with turnover of more than $10 million. So they're still, significant numbers, but they're not. We're not talking. These are not your, your mega ultra wealthy families, and they've identified 4 key areas, which probably shouldn't come as a surprise to anyone. Businesses using trusts, Division 7A, applying the small business concessions, and the incorrect reporting of income, which is a bit of a broad one, but is it revenue, is it capital, undisclosed income, etc. On the ATO's website, they give an example of a typical group, and this would fit a lot of clients. That's that bottom right infographic. So the group, the leader of the group's age is 63. They have 14 employees. They've got 5 entities in the group, 2 trusts, 2 companies, something else, and they have net wealth of $8 million. So that's the typical of what's going to be in this group.
Yeah, very interesting. It was like the 270 something thousand, but there's only 5 entities in the group. That's a lot of it's a lot of groups.
Yeah, it is. It's not clear, with that kind of number, it's clearly not everyone's going to be able to be reviewed. And it is interesting because they talk about things like tax governance and all that sort of stuff, which is all well and good for, public entities and probably even really large private groups. But for your, that typical example of the 63-year-old with 14 employees and 5 entities, like, they're not going to have tax governance.
Yeah.
So time will tell.
Yeah.
I'm going to move on to talk about ATO products and guidance update. I'm trying to leave as much time to talk about the cases because there's quite a few of those, and I think it's probably the most interesting area. In terms of products and guidance update, of course, the ATO releases a lot of products and a lot of guidance. So I've only picked out a few here. I've just picked out three. Who is an employee for the purposes of income tax and superannuation? What is the risk of income splitting when you're splitting income from a company or trust? And in what type of scenarios will Section 99B apply? I've got all the references there, and I've got slides on each of those. So the first one that I've listed there is, it's actually a 2023 reference, but TR23/4 DC1. This consolidates the guidance the ATO already had about who was an employee for the purposes of income tax and super guarantee. The main change is that they previously had an SG super guarantee ruling. I think it dated back to about 2005. They've now withdrawn that, and it's one comprehensive ruling. It's sort of like the one that they did for tax residency, that it's quite voluminous. It's updated with all the recent High Court decisions like personal contracting and JAMSEC and the others. And overall, it's positive. I mean, it's reflecting the case law, but it's essentially noting that, look, the contract is king. So the focus has to be the contractual rights created under the contract. And that was really brought home in JAMSEC and personnel not contracting and some other cases as well, that you got to assess on the contract. What happens in substance is not the test. And that's sort of a bit of a reversal on previous. If you've got a right to delegate, you're probably not an employee. It does note that it has to be legally capable of exercise, and it's not a sham or so limited that that it could never work. But it is okay if it requires the consent of the business. It clarifies also that you need to have a natural person to a contract to be able to be subject to super. If the contract is with a company or a trust and the individual is not even party to the contract, then you're not going to fall in the super guarantee definition of employee. And it also finally notes that you've got to assess what something is for. Is it principally for someone's labor, or is it some other benefit? So it's a pretty good ruling, pretty comprehensive. Encourage everyone to have a read of it. And yeah, I'd give it a thumbs up. The next one, which I won't give a thumbs up to, is the PCG 2024/D2. And this is about the Commissioner's compliance approach to situations where an individual is contracting through a company or a trust and alienates income. So Joe the plumber runs through a trust. It's just Joe. Or Andrew the lawyer runs through a company and there's nobody else. They meet the PSI rules because maybe they meet the results test or the 80% test. But what this says is essentially it's about the Commissioner's risk appetite, risk approach to applying Part 4A to those type of situations. It's sort of in the same vein almost as the previous PCG that accountants and lawyers had with the risk matrix with the green and amber and red and all that.
The traffic lights. Yeah.
Yeah. This one doesn't have a traffic light situation, thankfully. What it does is essentially just provides 6 low risk examples. They're all very uncontroversial and vanilla. They basically all just result in all the income of the contracting entity going to the person behind it. So of course that's, what risk is there? Probably the biggest takeaway from it is that they give 7 higher risk examples, and some of them are not particularly egregious at all. So it's a bit of a worry. It's sitting in draft still, and of course it's not a ruling, but I mean, what I've seen happen in practice is once the PCG sort of comes out on a topic, it becomes very hard and complicated to explain it to a client, because you're going to have to say, look, well, there's the law, and then the ATO administers the law, and then also they've got these some between the flag products, and it all becomes very hard and confusing.
The client just wants to know, like, oh, am I going to be in trouble or not? And it's like, oh, you might.
Yeah, and then all you can say is, well, if you follow these, you're not in trouble,
Mm,
and if you don't, then we can't give you that guarantee.
yeah.
And I think it's hard with the interaction between all the TASA things as well, with the PCGs and the TASA changes. It becomes, yeah, I do have a lot of sympathy. um, the third item is regarding Section 99B. This is the section that taxes untaxed income from trusts that go to an individual who's a resident of Australia. This section's been around for a very, very long time, and it's quite punitive in how it applies. There's two products that have come out. One is a technical product, the TD, and the other is a PCG. This PCG, however, is not a bad one. The TD is really sort of a technical product about the operation of some of the exemptions to Section 99B. Becomes very technical and complicated because there's a number of different scenarios that could apply. And there's these hypothetical tests about whether something should be taxable or not. So I encourage anyone, if they do have a situation that's involving any sort of foreign trust of any variety, or any trust that's not even foreign but was foreign, to really consider this and read it in detail. The points that I'll take away from this are the PCG points. And they essentially give you two sort of situations where we're swimming between the flags. The first is if you're dealing with a deceased estate, and it's a foreign deceased estate, and the money is distributed to an Australian resident beneficiary within 24 months, and the total value of the property received doesn't exceed $2 million. So in other words, if you get an inheritance from overseas directly from a deceased estate, not from a discretionary trust, but directly from the estate of an individual who's passed away, then if it's under 2 million and it's under 2 years, then you're going to be a low risk. The other one is about using property of a trust, or a foreign trust. And essentially this out says that if it's being done on commercial terms, and there's a physical payment being made, then that's not going to attract the commissioner's attention. So if there's a foreign trust and it owns a property in Australia, let's say, then so long as it's being used, it's being occupied on commercial terms, then you're not going to have an issue.
There's like a whole heap of examples. I think there were like 27. So we did a webinar previously on Section 99B, another one on the PSI and Part 4A one. So it's on the catalog if anyone wants to look. But it was very interesting just going through all the different examples that they gave in that PCG. I remember one that was like about artwork. It was like someone's uncle had artwork and they were like lending it to the person to put in their house. And apparently that counted as use of trust property. And it's like, how do you even put that on commercial terms? Like that's a bit much.
Yeah. That's it becomes tricky with like really unique things, and then how do you even work out what the value should even be anyway?
Yeah. Crazy. So Michael's just got a quick question on 99B. Would it apply to foreign pensions?
Good question. I'll disclaim that I'm not taking this as a definitive answer, but I would think that it would, because all it has to be is a trust of some variety. And a lot of things are trusts. So, for example, like a payment from a Singapore Central Providence Fund, which is like their retirement scheme, is like you have a 99B issue.
Very
even though
interesting.
it's a foreign pension.
Yeah. So things you might not even think about. Yeah, this one was definitely a bit of a sleeper provision that yeah
Yeah,
has been around a long time, but now the ATO is definitely putting more focus on it. So it's very
absolutely.
interesting that they've put these out.
Absolutely.
Yeah.
All right. Well,
Hey, on to the cases.
I'm going
More
to move on to the
exciting
cases,
things.
everyone's
Yay.
favorite part, particularly when the taxpayer wins.
Yeah.
And I've got lots of those, but I've tried to keep it balanced.
Yeah.
So just waiting for it to load. So I've got to split these up into a couple of different groups. Um, I'm going to talk about some payroll tax cases, and then I'm going to talk about some Part 4A cases, some onus of proof cases, and then a bit of a mismatch of ones that didn't fit in any other category, but I still wanted to talk about, essentially. So, payroll tax, the issue of whether or not contractors and people like contractors, whether they're subject to payroll tax, has been talked about for basically about 5 years now. It started with doctors, but it's spread much more broadly than that. And the reason that this is topical is because one, those arrangements kind of are they're in lots of places. You don't not think about them as a consumer, but they're in a lot of places. Um, and two, that the way the payroll tax rules are drafted, they're really broad about payments under contracts. And then I guess three, there were some favorable cases about 5 years ago, and maybe that coupled with desire to collect a bit more revenue has led to this situation. So there's two that I wanted to talk about from 2024. The first is Loan Market Group. It's a New South Wales case. And what this involved is it involved um, uh, brokers. Brokers would, so I'm a finance broker, and I've hitched my wagon to the Loan Market Group brand. And under that, I can use their platform, and then I'm running my own business, but then I can go sign up clients, get their finance. It can go through the loan market platform. And what will happen is when there's a loan signed up, uh, the commissions will come to the loan market group. Then they'll be distributed from there to the brokers. And then the brokers have to pay a fee to the loan market group. So let's just say there's a $100 commission that's payable. It goes to the loan market group. That's then supposed to be on paid to the broker. And the broker has a fee that they have to pay the loan market group of $20, let's say. So the net is 80. And the issue is, well, whether those payments, these people are clearly not employees, that's unquestionable. But whether or not those payments are subject to payroll tax, whether the loan market group needs to pay payroll tax. And it's under these relevant contract provisions. The case is a win for the commissioner. The court has said, yes, this is a relevant contract. And the reasoning is quite technical, and I don't have enough time to go through it. But essentially, they said that the brokers not only do work for the public, they also they're doing work for the loan market group. I sort of think about it as, well, the loan market group can't really operate without the brokers. So loss for the taxpayer.
Yeah. And someone's just asked, is this the final decision for the loan market group
I
case?
believe it's been appealed. Yeah.
Mm-hmm.
So
Okay.
yeah, I believe it's been appealed. Yeah. The other one that we've got, and one that will probably dwarf the loan market group, is the Uber decision. Again, this is a New South Wales case. It's Supreme Court. It's one judge, so it can be appealed to the Court of Appeal. I believe it has been appealed. The question was, okay, we all know how Uber works. I got the app. I need a ride. I put it all in. I didn't download the app. click, car shows up, I go to wherever, the money comes out of my account, and then on the back end, the money goes to Uber, like the loan market group, Uber remits the money on, and there's fees charged, essentially. So you might say, well, that sounds bloody, the same. Like, how is that any different? Now, the court decided in this case that it was not subject to payroll tax. And essentially that really all Uber did was act as a bit of a collection agency for the payments, and essentially the drivers weren't working for Uber. Now it seems a bit strange to me, and people have asked me, how can you reconcile the two? And look, to be honest, I can't. But what we do have is we have an appeal of this case. So in 2025, we will get an answer to this, and I think we'll probably get a bit closer to try to sort of resolve this whole how far do these relevant contracts extend. Now, this is a big dollar issue. This is the assessments in this case were $80 million. That's in New South Wales alone for a number of certain years. Now, you times that to all the other states in Australia and all the other gig economy players. It's a pretty big issue. So I want to move on from there to talk about Part 4A. It's thrown around a lot. It sounds big and scary, but it's not really that well understood. And it's difficult. It's a very hard thing to actually understand how it actually works. We can all sort of say, oh, it's a bit of a smell test, but how can you describe it in a bit more technical detail? And it's really difficult. We had 3 cases on this slide. There's 3 cases. Firstly, there's a Minerva. That's a full federal court case, and it involved a restructure ahead of an anticipated IPO. The restructure meant that funds flowed through a trust, not a company, and it ended up in the same foreign person. Regardless whether it went to the trust or company, it would have ended up at the same foreign head company. But there's a big difference between how it's taxed through a trust and through a company. The second one is Mylan, which is a federal court decision, and that involved a restructure of debts, essentially in a group, which resulted in the Australian entities having significantly higher interest deductions. And the third one is Ierna, another federal court case. It involved a restructure and whether or not certain capital payments that were paid as a result of that restructure, whether they should be treated as dividends under Section 45B or as a tax benefit under Part 4A. Now, I'm not going to go through the facts in any more detail in any of these cases because they're long and complicated. The main point I wanted to make is that in all 3 of them, the taxpayer won. And in Minerva and Mylan, the Commissioner has not sought to appeal those. In Ierna, the Commissioner has sought to appeal that decision. And in all 3 cases, the court said that the Commissioner's failed to make out Part 4A and hasn't failed to show the taxpayer entered into these for the dominant tax purpose. And they really were harped on about the point that for Part 4A to apply, you need to show what would have happened otherwise. And whatever that is, it has to be realistic. It can't be sort of some thing that's so fanciful and just doesn't work for other reasons. And it's not sufficient just for the Commissioner to say, oh, well, the taxpayer would have paid more tax if they did something different. So, yeah, it's a number of losses there. These are all, big dollar significant cases, but I think it will, that number of losses on Part 4A does change Commissioner's attitude to applying it more generally, although it could still be thrown around and scare people.
4A is pretty much the boogeyman that we start waving in front of clients like, oh, don't do this Part 4A, don't do this Part 4A.
Yeah,
but we find it's more the slightly bigger end of town. The ATO usually just goes after the bigger dollar people.
Yeah. But it's good to still understand because
Yes.
it could apply to anything. And there was one case where the Commissioner did win on Part 4A. It's the merchant case, which was in the media quite a bit. Gordon Merchant founded Billabong, and there's some media stuff about him suing his advisors. But the issues here was it was about a sale. There was Mr. Merchant essentially had two different business arms. He had Billabong and a bioplastics company called Plantic. And what was done, what the advisors suggested was that, look, Mr. Merchant, you've got these shares in Billabong and they've got big unrealized losses on them. What about you transfer them to your self-managed super fund, because a listed entity, so you can do it, and that'll crystallize a big capital loss. And then you can apply that capital loss to the sale of Plantic. So basically a wash sale. And the Part 4A held up on that no, really the evidence really was pretty clear that the only reason you did this was for to get the wash, basically. And there was arguments that, look, well, it's in super, it's for my retirement, et cetera, but it wasn't consistent with the evidence that was there. So it's all well and good to say, oh, well, it's a different taxpayer and, it's a real economic effect. But what does the evidence actually look like and how consistent is it with that? The other thing that happened in that case is there was a big forgiveness of a related party debt just before the time that entity was sold. So otherwise, the entity would have had to, repay that money. And they said that was a dividend strip. It was done for the reason of reducing, having to pay that money back to a corporate in the future. All right, onus of proof. I'm going to skim through these cases pretty quickly because there's about 4 of them and we only have 15 minutes. Every year there's a number of onus of proof cases, just due to the way the tax system is designed. But I think this was a particular year for them. And there's a number of sort of questions about how do you prove the onus? What is the onus? What is the standard? And it can be really hard because, as you tell clients, well, if the ATO says it's the case, you've got to prove it the other way. So I'll run through these. We had Buzadzik. This involved Mr. and Mrs. and a number of companies and trusts. It was all controlled by the husband. There were default assessments issued under Section 167 for a series of things. There were unexplained bank deposits, interest, Div 7A dividends, capital gains. Commissioner won, and the court said, well, taxpayers got to prove not just that the assessment's wrong, but what it should have been. And they failed to discharge their onus, failed to provide adequate records, evidence, source, etc. I think the surprising thing about this is that there was an AAT case, a federal court appeal of that, and a full federal court appeal. They were all losses.
Yeah. I mean, it must be pretty serious for them to take all the way up to the full federal court.
Yeah. Yes. The next one is Barzo. Again, a federal court case. Miss Barzo had 230 properties registered in her name. Now, before the case, the commissioner agreed that only 8 of them were held in her own right and the rest were held on trust. There was default assessments issued again under Section 167, $14 million, and it was for unexplained accumulated wealth using the asset betterment method, and also a series of transactions passing through her bank account. The takeaways here, this was it was a partial win for the commissioner, partial win for the taxpayer. But the takeaways here is that if the asset betterment method is used, the taxpayer needs to account for the unexplained increase and explain the source of assets and identifying that that's not taxable. The case also involved fraud or evasion, the commissioner finding being of the view that there's fraud or evasion. And it confirmed that the role of the tribunal, if you are challenging a fraud or evasion finding, is that they then make their own view. It's not enough. Okay, the commissioner formed the view, but it is challengeable, and it's a technical point, but the question was essentially, did the commissioner form the view correctly, or are we going to remake that? And essentially they said, well, no, we need to remake that decision. whether or not there's fraud or evasion. That's a positive note. Rusinov, this one's probably not that spectacular. A covert audit, $1.6 million unexplained back deposits, default assessment. Argument was that there were non-assessable gifts, there were loans, etc. Failed to discharge their onus of proof. There wasn't contemporaneous records. And one note there is just Division 7A can apply to loans from foreign companies to Australian residents. There's two more. There's Liang, which Velocity Legal actually acted in. In Liang, the taxpayers operated some takeaway businesses via discretionary trusts, and they had some property investment activities as well. Now, in this case, the ATO issued an amended assessment under Section 166, not a default assessment. And it was to do with 7 unexplained bank deposits into the property trust account, around $700,000. It was quite an interesting case. Essentially, the taxpayer lost in the tribunal, but won on the federal court. And essentially what the federal court said was the ATO made a series of concessions about, and it's in that quote there, that the ATO conceded that it wasn't income from services, it wasn't interest, it wasn't dividends, it wasn't something else. And essentially what the judge said in the federal court case is, look, the taxpayer's evidence wasn't great, but with all those concessions made by the ATO, it can't have possibly been income. And it's really interesting because it's sort of juxtaposed with all these other cases where she said, well, the onus of proof is that you've got to positively show, not that just this is wrong, but what it should have been. So it can be really difficult sometimes to work out actually, what do you actually need to do? This has been appealed as well. So there'll be a full federal court decision on this next year. Okay. Final one on onus of proof. This one came out a couple of weeks ago. Chung. Mr. Chung was born in Vanuatu, seven siblings, and his elder sister ran the largest supermarket chain, ABM. Mr. Chung relocated to Australia in the 90s and retired in the 2000s. And from 2005 to 2015, $33 million was transferred to him from his elder sister. And it was done over 99 deposits over 10 years. And the issue was whether or not that $33 million in transfers was assessable income. The ATO said it was. But what did the federal court say? Funnily enough, when I was looking up this article, I actually found an article saying that it was in the AAT and then went to the federal court. But it seems to be just something that was just made by ChatGPT, because I was sort of scouring around and I was like, I can't see that there's an AAT case. Am I going crazy? So anyway, caution on relying on stuff on the internet that isn't the source material. So the arguments were about things like, well, look, there's so much, it's so regular. Could it be an income stream? Well, Mr. Chung, he was involved previously. Maybe those payments were tied to his previous contributions, and a bit of an absence of formal, like there are a lot of family situations, formal documentation at the time about the classification of these things. The taxpayer won, and the judge said that none of these payments were income under ordinary concepts. They were simply deposits of gifts of capital voluntarily made by a loving sister who had an acute sense of family, loyalty, and responsibility. Now, so complete win for the taxpayer. There's two really, really interesting points, and it's a bit scathing, the judge on the tax office. The first is what they say is the importance in tax administration of open-mindedness and detachment from the assessment on objection cannot be overemphasized. Essentially, it's saying, look, when it goes to objection, you need to sort of detach from the original decision. You've got to make it again. And that's what's supposed to happen. But that is really emphasizing that. The second is, again, talking about onus. No onus is cast on the commissioner to prove that an assessment's not excessive. But what it goes on to say is that, look, putting a taxpayer to proof on things, like relying on the onus, just saying, oh, well, it's your issue, which aren't truly controversial, is essentially contrary to fair play. And that can be essentially an instrument of oppression if that's not done. It's a really interesting theme of cases on onus of proof. I'm going to fly through the rest of these, and I'm conscious of time.
Yeah, just over 5 minutes left, Andrew.
Yeah, we had two arm's length cases. One was Maloney. This involved an internal restructure, and it was about whether or not the business was worth sort of circa 3.5 million or 10 million. The taxpayer said it was 3.5, and then they applied small business concessions and that sort of thing. The ATO said, no, we've got our own valuations, 10 million. The court accepted ultimately the taxpayers, something very close to the taxpayers' valuation. I think the takeaway here is be prepared for the commissioner to challenge valuations, particularly in an internal restructure type context. The second case on arm's length is a little bit of an unusual one, is Cligor. In this situation, there was a sale of shares in an online gambling company to News Corp for $31 million. The taxpayer wanted to argue that that wasn't the market value and that the market value was a lot lower. And it was so much lower that the taxpayers should be able to apply the small business concessions. Now, to get that argument up, firstly, they would need to establish that there was not a dealing on arm's length. And then there would have to be a secondary argument about what the value actually was. So unless if they were dealing on arm's length, market value is not even relevant anyway. And what the courts, essentially there was sort of some arguments run that it was kind of like a bit of I've got some friends in high places and this transaction happened as a result of that. But the judge concluded, no, that's not the case, that there was no collusion. There might not have been 10 back and forward contracts, but there were independent parties and it wasn't a mere rubber stamping. The judge also went on to talk about market value because there was an argument that, well, the value to News Corp was so much higher than anyone else. And essentially said, well, that's still market value if someone's willing to pay it.
Yeah.
I think that's one's been appealed. Residency, we had Key. This was another one of these Australians that go overseas, but they maintain connections to Australia, family home, wife, and adult or young adult children. The taxpayer was in Australia for less than 2 years, so 2 months each year. And this is over a sort of a 5 to 10 year period. It was mainly in Dubai. The AAT found that he was still a resident of Australia. The federal court said that the AAT got the test wrong. So it's sort of a win to the taxpayer, but what they said is go back to the tribunal and remake the decision. So it's not necessarily a win. It probably just highlights that, you can be a resident, particularly where you keep those connections to Australia, even with very little physical presence. It also just highlights the difficulty in this area. Finally, we have a case on land tax and dominant use. In this case, it involved a taxpayer who owned land in New South Wales. It was used essentially for an integrated operation of breeding horses and racing horses. And to get the land tax exemption, the dominant use had to be primary production. So the question is, well, how much other activities can you have and still get the land tax exemption? The commission, it's a high court case. Commissioner won. The land didn't qualify. A significant use of the land was for breeding horses, but they fell short of demonstrating that dominant use point because it was sort of intermixed. It's not on the slides, but one further a shout out was in respect of the landholder duty rules, there was also a case on capital raisings, and that capital raisings of entities that have land can be subject to landholder duty in a lot of cases.
Is that the Oliver
The
Hume
Oliver
one?
Hume case, yeah. You remembered it before I could. So just a quick eye towards 2025. I don't have a crystal ball, but here are some things that I think will be there. We'll have a decision in Bendel, I hope, at some point. And we'll see where that whole UPE Division 7A thing goes. The Liang case will be decided, and that will be interesting about exactly where the onus of proof lies. I think we'll have a resolution of Uber, and how far the contractor payroll tax rules go. We've got a federal election, so that's always politics and tax are intertwined. I think there'll be a continued focus on property and construction, and the tax of property. There's also the implementation of the TASA changes and what that actually does in practice. And there's been a lot of talk and scrutiny about family trust distribution tax, which is something that hasn't really been talked about a lot historically. And it seems that that's really coming into focus. And I expect that to continue into 2025 in terms of the ATO asking questions and really sort of applying it a lot more than it's been applied previously.
Also, thank you very much for participating. And we do have 2 questions, Andrew, but while we're doing those 2 questions, we'll just quickly put up the ratings poll. So if you could please just give our feedback for today's session, let us know as well. We are already booking in lots and lots and lots of events for next year. Like I said, we've got an event a day at least next year, except for the public holidays, of course, because we need a break too. And if anyone's got any ideas, feel free to pop them also in the comments box. So this first question, Andrew, is about the Div 296 tax, I guess, as it is at the moment, I guess. Yeah. What happens if or when the pension account grows past $3 million due to investment growth? Will this then become taxed? Now, this is one of the problems about it, right?
Yeah. Yes, it will. Yeah.
So also someone else asked, is that per person, the $3 million per person balance?
The balance is per person. Yeah.
Perfect. And then next one is from Andy, and this is about Cheung's case. So this was the guy from Vanuatu who got the very nice sister who gave him $33 million. I wish I had a sister who gave me $33 million as gifts. What would the ATO consider as formal documents for documenting, what was happening?
I mean, that's the thing, families don't do formal documents a lot of the time.
Yeah, we just WeChat each other and be like, hey, I'm going to send you this money and enjoy.
I think the best way is to read the case and see, but where taxpayers don't have any evidence and when their statements are completely self-serving, the judges and the tribunals call that out. They always call that out. They always say, well, this doesn't make any sense. This is not plausible. They call the BS basically. But when it's plausible and the people are believable and there's, some corroboration and the number of people who've given witness statements, etc., then they say, well, yeah, that seems reasonable. That sounds like it actually happened. So that's essentially what's happened in that case. Do you want to be in that situation? No, but could it have been avoided? Perhaps. But yeah.
Good answer. And then a question from Anna. This is about employee versus contractors, I guess. So she's asking, can a company director become a subcontractor to his own company?
Can a company director become a subcontractor to his own company? I suppose so. I guess you could probably question why you would want to, but a lot of times you might be starting to invoke payroll tax and things like that, super, work cover. So I guess it's probably just would you want to? I guess is the question.
Yeah. Cool. I think that's all the questions we had for today. So we'll also wrap up the feedback poll. And for the newbies who are still around, could you also pretty please answer one more question about where you heard about tax nuggets from, just so it helps us to reach out to more of you. Thank you very much. And so, Andrew, while we're doing that, do you have a key takeaway for today's session, just about all the things that have happened during the
Look,
year?
there's so much that's
Oh,
happened, but I
yeah.
think the main takeaway for me is just you've got to keep on top of tax updates, because what you think might be right 2 years ago and now can change so quickly. And being on top of these things, explaining them to clients will set you ahead of others. I mean, I know that's a bit of a plug for Tax Nuggets, but it wasn't intended to be. Look, I think just that you don't want to be up against the ATO, but if you are, keep in mind that there are plenty of cases where the ATO's got it wrong.
Exactly. And that's also a key takeaway as well. It's like the ATO doesn't always get it right, and you shouldn't be afraid
I
to
think I'd say the
correct them as
biggest
well.
key takeaway is that
Mm,
emerging private and medium groups
yes.
program, because I think that's the biggest thing that's probably you're gonna see next year.
Yeah. And someone did mention in the chat earlier that like it becomes almost like an urgent thing to do as soon as you get that letter. So I was involved in one of these before I left public practice. And the ATO literally sent us, I think it was like a 22-page questionnaire and asked us to do it for every single entity in the client group. And I was like, do you realize how many entities there are in this client group? It's like
Yeah,
over 50. And I got to prepare all these answers. And this is just like a review, right? It's like a preliminary thing. They're just information gathering. I'm like, I have other things to do. But anyway, we're expected to see a lot more of these because of that next 5,000 or
yeah,
270,000
yeah.
entities. So it'll be very interesting to see next year. But yeah, not to toot our own horn, but we do have our comprehensive and essentials tax updates next year that run uh, twice a month for February to November. So we do help everyone keep on top of everything. We hope there's always lots to talk about in tax, and we do understand because we used to be practitioners ourselves. We just want to help you guys all just keep on top of stuff and make your life a little bit easier. So thank you everyone for coming along today. You've been an amazing audience. Thank you also for participating in the hashtag giveaway as well. Thank you so much, Andrew, for today's webinar and also all the other webinars that you did for us earlier this year. And we'll
Pleasure.
be very excited to have you back next year and to see everyone else. So thank you all our Nuggeteers for a wonderful year. And yeah, see you next year.
See you
Thank
next
you.
year.
Bye.